The federal funds rate has predicted every recession since 1950. Right now, it's flashing the biggest red flag since 2008. Today, I'll decode why 2025 could trigger the next great recession, and how to turn this crisis into your greatest opportunity. Let's get started. Before we dive into why 2025 is looking scary, we need to understand the federal funds rate. This is the interest rate that banks charge each other for overnight loans, and it's controlled by the Federal Reserve. When the Fed raises the interest rate, it becomes more expensive for everyone to borrow money. Think about your credit card, your mortgage, even car loans. Everything gets pricier. This has a ripple effect throughout the entire economy. Businesses delay expansions, people put off big purchases, and overall spending slows down. And guess what? That slowdown often leads to a recession. Now let's talk about timing of recession. Always recession will follow when Feds start reducing the interest rate after reaching the peak. This is proven again and again in every market cycle. In 2000, right before the dot-com bubble burst, the Fed funds rate hit 6.5%, and then Fed started reducing the interest rate. The result? A recession. Then, in 2008, leading up to the housing market crash, the rate peaked at 5.25%, and then Fed started reducing the interest rate. Guess what? A recession. Fast forward to today, and the Fed has been aggressively raising rates to combat inflation. We reached above 5.5%, the highest it's been since 2007. Now Fed started reducing the interest rate. As per the previous cycle, we can expect a recession in next 6 to 9 months. We've got this ticking time bomb of high interest rates, and now we need to talk about what's going to set it off. There are a whole bunch of triggers lining up perfectly for 2025. First up, we've got a massive corporate debt bomb about to explode. According to Moody's, over $10 trillion in corporate debt is set to mature by 2025. When interest rates were low, companies could refinance this debt relatively cheaply. But at 4.25% or even higher, refinancing becomes insanely expensive. We're talking about a potential wave of defaults that could make 2008 look like a walk in the park. Let's talk about consumer debt. Credit card debt in the US just surpassed $1.13 trillion. That's higher than it was right before the 2008 crash. And delinquencies are at levels we haven't seen since, you guessed it, 2008. So, we've got businesses drowning in debt and consumers tapped out. What else could go wrong? Oh right, the commercial real estate market. Over $1.5 trillion in commercial real estate loans are set to expire by 2025. With more people working from home, office vacancy rates are through the roof. We're talking 35% in some major cities. And as if all of that wasn't bad enough, we've got some major geopolitical wildcards in the mix. The BRICS nations are actively trying to de-dollarize the global economy, which could weaken the US dollar. On top of that, we've got AI rapidly automating jobs away. This mass unemployment is going to put a huge strain on the economy. And to top it all off, we've got climate change fueling more extreme weather events like hurricanes, floods, and wildfires. So yeah, 2025 is shaping up to be a perfect storm of economic chaos. We've talked about the federal funds rate and the triggers that could set off the next recession. Now let's get even more specific and look at one of the most reliable recession indicators out there, the inverted yield curve. This is a fancy way of saying that short-term interest rates are higher than long-term rates, and it's a huge red flag for the economy. Normally, you'd expect to get a higher return on your money if you lock it up for a longer period, right? But when the yield curve inverts, it means investors are so nervous about the near future that they're willing to accept lower returns on long-term investments just to keep their money safe. Let's compare 2024 to what we saw back in 2007, right before the last financial crisis. In 2007, the Fed funds rate peaked at 5.25% before the market crashed. Today, in 2024, we're at 4.5% and inflation is proving to be much stickier than the Fed anticipated, sitting at a stubborn 2.89%. This means the Fed will likely have to keep rates higher for longer to really get inflation under control. Bloomberg's analysts are projecting that this delayed reaction could trigger a recession lasting anywhere from 6 to 9 months. This could be a significant economic downturn. Listen, I know all of this might sound scary, but knowledge is power. By understanding what's coming, we can prepare ourselves and actually come out ahead. So let's dive into a 5-step plan to not just survive the next recession but to thrive during it. Step 1. Dump those risky assets. I'm talking about overvalued tech stocks with insane price-to-earnings ratios. Those meme stocks that are being pumped up on social media, and any unprofitable startups that are relying on cheap debt to stay afloat. Get rid of them now before they crash and burn. Step 2. Buy recession-proof assets. Think about it. What do people always need, even during a recession? Well, for starters, gold. Central banks around the world have been stockpiling gold like crazy. In fact, they added over 1,200 tons to their reserves in 2023 alone. You can buy physical gold, invest in gold ETFs like GLD, or even look into gold mining stocks. Another great option is US Treasuries. With interest rates high, you can lock in some pretty sweet yields right now. The TLT ETF is a good way to get exposure to long-term Treasury bonds, and of course, you can't forget about defensive stocks. These are companies that sell essential goods and services that people will always need regardless of the economy. Think consumer staples like Walmart and Procter & Gamble. Step 3. Build up your cash reserves. I always recommend having at least 12 months worth of living expenses saved in a high-yield savings account or a money market fund. This gives you a cushion to fall back on if you lose your job or face unexpected expenses during a recession. Step 4. Invest in yourself. The best investment you can make is in your own skills and education. Learn high-demand skills like AI prompt engineering, cybersecurity, or anything in the healthcare field. The 2008 financial crisis was brutal. Millions of people lost their jobs, homes, and life savings. But it also created incredible opportunities for those who were prepared. The people who not only survived but thrived during that time were the ones who saw the warning signs, took action, and positioned themselves to capitalize on the recovery. They bought gold when it was cheap, they scooped up shares of Amazon when everyone thought it was going out of business. Some even bought Bitcoin during that time. Now, I'm not saying history will repeat itself exactly, but there are valuable lessons we can learn from 2008. This time around, the crisis won't just be about housing and subprime mortgages. It's going to be a global debt crisis amplified by technological disruption and geopolitical uncertainty. So how do we position ourselves for this new landscape? First, we need to look beyond the traditional safe havens. While gold and treasuries will still play a role, we need to think about assets that will benefit from the trends shaping the future. One area I'm particularly interested in is AI utilities. These are the picks and shovels of the AI gold rush, the companies providing the infrastructure and tools that power artificial intelligence. Another area to consider is farmland. No matter how crazy the economy gets, people will always need to eat. Look, I'm not going to sugarcoat it. The economic outlook is uncertain, and there's a very real possibility of a recession in 2025. But here's the good news. You don't have to be a victim. By understanding the risks, taking steps to protect yourself, and positioning your portfolio for the future, you can not only weather the storm but come out stronger on the other side. This is your wake-up call. Don't wait until it's too late. Subscribe to @TheEconomicFallout and hit the bell. Let's get through this together. Protect your wealth, protect your family, stay prepared. This is Paul for The Economic Fallout.